It's 4:47 p.m. Your phone lights up. Unknown number. A calm voice says, "I can hold it for you until 5. After that, it goes to someone else." And suddenly, your brain isn't thinking about risk. It's thinking about losing. Because urgency doesn't feel like pressure. It feels like a deadline that the universe created just for you. Here's the uncomfortable truth. In money, the faster someone needs your decision, the more likely they need something from you that they can't get any other way. Not your signature, your cash. And the clock is their best weapon. So let's talk about why urgency is a red flag. Not always, but often enough that ignoring it is how intelligent people end up financing someone else's disaster. And why this matters right now is simple. We're living in an economy where attention is expensive, capital is tighter, and everyone from startups to financial coaches to legitimate institutions has learned the same lesson. If you give people time, they ask questions. If you don't, they comply. The modern sales funnel didn't invent this, finance did, centuries ago. Because money has one feature that makes urgency uniquely powerful. Once it leaves your account, the fight to get it back is uphill, and the person asking for it knows that. Let me show you how it usually plays out. It starts with a story, not a spreadsheet. A friend of a friend, an invitation-only round, a private deal, a preferred allocation. Then comes the time box. You have 24 hours, or the classic, "We're closing the round tonight." That's not a detail, that's the core mechanic, because time pressure does something predictable to the human brain. It replaces analysis with instinct. You stop asking, "Is this good?" You start asking, "What if I miss it?" Now, in real markets, good opportunities exist, but notice something about most legitimate opportunities. They're documented, they're explainable, they survive questions. They don't collapse if you sleep on it. If a deal can't tolerate a weekend, it's not allergic to time, it's allergic to scrutiny. And there's a reason. Urgency isn't just a persuasion trick, it's often a symptom of a funding problem. Here's the step-by-step of the system underneath. Step 1. Someone has an asset, a product, or a promise that needs buyers. Could be a piece of real estate, a fund, a crypto token, a note, a franchise, even a high-fee insurance product. Step 2. Their payoff depends on your timing, not your outcome. If they earn a commission when you buy, they get paid today whether you lose later. If they're raising capital to keep a business alive, your money is oxygen now, not growth capital later. If they're trying to exit a position, they need liquidity, meaning they need someone to take the other side of the trade. And that's where urgency becomes logical. Because when someone's incentive is, "Get this done now," the easiest way to do that is to shrink your decision window until your due diligence doesn't fit. No calls with a lawyer, no reading the offering documents, no comparing alternatives, just vibes and a wire transfer. And once you understand incentives, urgency stops looking like excitement. It starts looking like a cash flow mismatch. Now here's the uncomfortable math that sits behind a lot of act now investing. Take the classic promise, "We can get you 2% per month." 2% sounds modest, almost boring, until you do the adult math. 2% per month compounded is about 26.8% per year, consistently. In the real world, a long-run stock market average is often quoted around 8 to 10% a year. Not guaranteed, volatile, but historically resilient. So if someone tells you they can deliver nearly triple that, smoothly, and they need your money by Friday, ask the obvious question, why are they calling you? If this were real, scalable, and low risk, it wouldn't be sold with a countdown timer. It would be absorbed by institutions with teams of analysts and lawyers who do nothing but hunt for mispriced returns. The existence of the urgency is the clue, because often the urgency isn't about you getting in, it's about them staying afloat. This is where the tone shifts from marketing tactic to structural red flag. When a business, a fund, or a scheme runs on continual inflows to pay obligations, time becomes an enemy. If money slows down, the machine shows its wiring. Think of it like a restaurant that only survives if every table is filled every minute of every day. That's not a great restaurant, that's a panic system. And the moment it's not full, the illusion breaks. Finance has its own versions of that restaurant. Sometimes it's a literal Ponzi where new money pays old investors. Sometimes it's a legit company with brutal cash burn and no runway, raising a bridge round that's really just a bridge to the next bridge. Sometimes it's a product that's overpriced, so it must be sold before you price check it.
Sometimes it's a fund holding illiquid assets, things that can't be sold quickly, while promising you liquidity, meaning the only way they can meet withdrawals is by bringing in fresh deposits. That's not always fraud, but it is fragility, and fragility loves urgency. Now, here's the irony. The public hype always frames urgency as generosity. We're letting a few people in, as if the seller is doing you a favor by accepting your money. That's a hilarious concept when you say it out loud. Imagine a grocery store clerk whispering, "I can allow you to purchase milk, but only for the next 10 minutes." Yet, in finance, people accept that tone constantly. Because the underlying reality is usually the opposite of the hype. If the deal were truly exceptional, they wouldn't need to chase you. They would be turning people away, not calling you at 4:47 p.m. And yes, sometimes there are real deadlines. An auction ends, a bond offering closes, a company's funding round has a final date. But real deadlines come with real process, paperwork, disclosures, time to ask questions, clear explanations of risks. A legitimate professional doesn't punish curiosity. They welcome it because it protects everyone. The sketchy version flips that dynamic. Questions become negativity, hesitation becomes fear, and the deadline becomes a moral test. Which is absurd if you think about it. The market doesn't care about your courage. The market cares about your entry price, your liquidity, and your ability to survive being wrong. So zoom out. What are the long-term implications of a world built on financial urgency? It means more people buying complex products they don't understand, more capital flowing to the best marketers, not the best businesses, more blow-ups that look sudden but were actually predictable because the entire structure required constant new money and constant new attention. It also means something quieter. It trains you to confuse speed with competence, to feel proud that you moved fast, when in reality, moving fast is often just moving blind on someone else's schedule. And that brings us back to the phone call. Buy 5, they said. Here's the question you should hear underneath that sentence. What happens to them if you don't? Because if the opportunity is real, it will still be real after dinner. And if it isn't, then the deadline was never about the deal. It was about outrunning your judgment. So the next time someone demands urgency with your money, don't ask, "What if I miss this?" Ask the more dangerous question. What exactly are they trying to beat? The clock or the truth?